So, just left St. Louis after a few days over there and spent some time with some really, really hard hitting some bitches that are just working on business. And one of the things that we just kind of come to the conclusion of is not a damn thing's easy right now. It is really a fight to get everything done. It's amazing how many people have had to pivot over the last few years. COVID was a big game changer for the world. I mean, we know that in many senses, but you're talking about people's businesses, massive shifts, massive adjustments. For them to continue building business the way they had been building it, they have to completely adapt. And we're doing the same thing. We're adapting. We're trying to help the real estate investors as much as we can. What we've noticed that the big flood of people going after real estate investments, not so big a flood anymore. Everybody's asking, okay, where are the investors at? What are they doing? It's like, well, when we had this whole situation of 2, 3, 4% interest rates, it was easy. You're not a real estate investor, you're an opportunivore. We had opportunivores coming out of the woodwork, but now we got to get granular. We got to really, really help people understand what a real estate investment is, what it makes sense as a real estate investor. So I'm going redneck Jerry Maguire, really digging deep and trying to figure out the individuals that we can truly help to become extremely wealthy while the rest of the people are sitting on the damn sidelines hoping for some interest rate drop that we're not going to freaking get. That's the most amazing part of it. We're not going to get it, guys. I'm sorry, but it's not going to happen. I don't believe it's going to happen. I truly don't believe it's going to happen. Now, people think it's going to. You're going to be sitting for a long damn time. Just my thought. Here's what we got right now. So we talked about how the market was earlier in the week, what was happening. New home sales down. Durable orders, those are up quite a bit, actually. Durable orders, excluding transportation, up a lot. Nearly 5 times what the anticipated amount was going to be. Now, I mean, we're talking about, 1/10 of a percent to where it's now is up to 0.5%. So, 0.5, but it's quite significant when you're talking about a global scale. Remember what I said about Jamie Dimon, $100 trillion a day moving through the markets? Tells you what kind of scale we're talking about here. We've got initial claims, those are down. So, people filing for unemployment for the first time is down a bit. Continuing claims, they are up from the previous reading. Now we've got the international trade goods. That looks like that's a decline. Pending home sales, that went up quite a bit. Got to jump in home sales, guys. You may want to be looking at homes prices. Personal income, that dropped quite a bit, actually. Personal spending is down a bit. Personal consumption expenditures index, that's flat from what they anticipated. They anticipated 0.1%, and it's maintained the same. The PCE core is up, so that inflation went up a little bit, and consumer sentiment is pretty flat, but it's up still a tad from where it was before. So my argument still on the interest rate front of things, we're going to continue to see us trade in this range. Now we look at this range. I'm not going to be able to show you today's movement because it's come up but come back down. For some reason, it's not wanting to update. But if you look at this range. We had quantitative tightening start right here, 2021. So quantitative tightening started right here, fell off a cliff. A lot of trading out of those bonds at that point. So I'm going to bring this down so we can see the dates. So, right, 2021, we started to really start to trade out. We all fell down to our bottom. Look, we're bottom at this point. Come back up into the point where mortgage-backed securities had their value based upon the date of that quantitative easing was announced. Didn't make it above the full trading day of quantitative easing announcement day before it went back down. Blew to this level. Now, why did it blow to this level? We think back on this. This is when we had, the Biden administration really touting how much they were kicking ass with jobs. They were creating new jobs. It's the greatest thing that's ever happened in the history of mankind, the job things. They were inflating the numbers and cooking them off of COVID returns post-COVID, right? So when you're talking about post-COVID, look at that. I'm going to have to shrink this quite a bit. COVID happened here. This was the COVID movement. Sorry, guys, this is a lot of movement. I'm sorry that we have to do it that way. I'm on my travel screens. So this is COVID right here. It was in March of 2020. That's COVID. Look at all that quantitative tightening come back. Now we finally have people returning to work. And as a result of that, we've had all this, the bull crap that was going on, them saying how they're bringing people back into jobs. Jobs means inflation. We're going to talk about inflation. Bonds are going to respond negatively to inflation as a result of that. And then we had the real numbers come out in October 2023 and start showing how cooked that was. And bonds rocketed up because the market was much weaker than they were trying to make it sound. They were sounding like badasses when they really freaking were. But it reached a point. Which was that point? That was the point where they announced quantitative easing in 2020. 2008. It backed off of that point because that's where the true value of the security is. Came back down, rocketed back up. This is where we had stock market took a monster beating, rocketed through that and up to the point, again, where the peak out was from that day's trading. Then it fell back down, tried to test it again, got into the channel we were using for quite a while, and then, of course, worked back up into it, came back down hard. It's working back up there again. Now, I'll have to go and switch us charts here so we can look at the charts without any of that data. So you can see where we have rocketed up a little bit, we're receding back down. So we're coming off of that level. In fact, I'm going to change screens here because I don't like that screen. Let me use a different one. Let's use this one here. Let's use this chart. So if we're looking at this chart, you'll be able to see we're still well below that level. That same level for quantitative easing was announced. We're going to trade in that range. That's my anticipation. We're going to be swinging in here. This is where we're going to play. Now, since I'm going to share screen. I'm going to change my share screen to this one here. You go back to this screen. Now, if you look at this, where our levels are, we're going to be trading going up. We hit that, come back down, hit that again. We go and we hit the bottom of the trading of this block. So we went to the top of the block, came down, hit the bottom of the block, came down, hit the top of the block, came down, hit the bottom of the block. So it's a possibility we may go to the top of the block again, but we're going to go back down. So this is our range. This, I think, is our interest rate range right here. I just think the history is proving this is what's going to be, and these are the places we're going to trade in, and that's our channel. That way, we're going to have channels go downward, bring us back up. Channels go downward, bring us back up. Oh, sorry, moving these things around a little bit. I grabbed it accidentally. So that's what we're going to be seeing for the coming future. That's my anticipation. I could be wrong, but so far everything we've been talking about seems to fit within that price action. So that's where we anticipate interest rates to go. You may see a 0.5% better in cost over time if it does go to the peak of that block, but that's not a lot. It could go the opposite direction. There's a lot happening in the economy that we're really not certain of, but I always tell everybody, lock it. Keep moving, because if the rates go down, the prices go up. You're going to pay for it one way or the other. You might want to get it today's price and wait. That's the goal. That's what I'm thinking. That's where we should continue to move forward, lock and just move forward. If you're sitting here just looking at every bit of news, oh, they said the rate go down, what can I do? Guys, be a real estate investor. Don't be an opportunivore. Don't be some sort of consumer being pushed around by news. Focus on what you're doing and move forward. There's not a single person who's ever lost doing that. Remember what I said about that one individual that said Charlie Munger told him, never sell a house, never let interest rate influence you. Let your mind focus on other things. Don't get influenced by noise. Noise is just going to do nothing but mess with you. And it really, you get tax deduction to offset it. The rates are not as big a deal as people want to make it out to be. If you're having a hard time with that, then let's chat. Talk to you soon.